economics, and I'm going to try and make it as exciting as economics possible. I was featured in a story recently, about 6 weeks ago, in the New York Times. There were a handful of us that have been speaking out publicly against shale gas economics. And the Times ran an extensive story that it was in 3 parts over 2 days. You can read it. Since that time, and because of the story, last month in July, the SEC subpoenaed a number of shale gas companies to examine reserve estimates and costs, and we're going to talk a little bit about that tonight. And as of about 10 days ago, the New York State Attorney General also issued subpoenas to a number of shale gas companies. So what's all the fuss about? Why is the SEC upset? Why is the New York State Attorney General upset? Well, let's take a look. Why we should question shale gas. There's no doubt the gas exists in shale. That's a given. Too much emphasis, however, has been focused purely on the amount of gas trapped in shales. But much of this gas may never be commercially extractable unless natural gas prices rise dramatically. And, of course, if that happens, then natural gas is no longer a cheap source of energy. Shale gas is useful only if it is truly cheap and abundant, which the industry tells us on a daily basis. Shale gas, especially natural gas, is cheap and abundant. It's only useful if it is cheap and abundant. But closer inspection of drilling data and financial reporting show inconsistencies about these claims. Let's look at some of the rhetoric from the industry versus the reality. This is a quote from Jim Mulva, CEO of ConocoPhillips, who said, "If oil is the prize, then natural gas is the gift, nature's gift to the people of the world." But Platts Oil and Gas Reporter, one of the preeminent industry publications, had this to say about shale gas. "The switch from shale gas to shale oil suggests shale gas can survive only through cross-subsidization, not on its own merit. Perpetual expansion cannot forever disguise a serious problem with the bottom line." This next quote comes from the most current investor presentation that Chesapeake Energy is using with institutional investors. And it says, "Chesapeake's track record of leadership and achievements during the past 22 years has been unique and has positioned the company for superior performance for years to come." But again, according to Platts, preeminent industry publication, they note that since the company's founding in 1992, Chesapeake has reported a cumulative net income of minus $368 million. Now that's unique, I grant you. Whether that positions the company for superior performance for years to come is, I think, debatable. Again from Jim Mulva, "Gas can enhance energy supply security through its abundance. There's enough to meet industrial, residential, commercial, and power generation needs. But Bernstein Research, which is our preeminent, or one of our preeminent financial research firms, and this is from Ben Dell, who is one of the best oil and gas analysts, financial analysts in the U.S., had this to say, "Recent frac data from the Barnett shows a play in severe decline. The Barnett's well failure rate also continues to rise over time." So, there appears to be a great deal of confusion regarding production versus reserves. A leading argument states that shale gas has risen from 2% of all natural gas production in 2000 to 23% only 10 years later, a statistic the MIT group called a paradigm shift. But this is misleading unless put into context. Drilling for conventional gas, i.e. vertical drilling, where you just sent the drill bit down into a pocket of gas, began to wane in this country in the 70s. When shale gas came on the scene, and that was horizontal drilling, which is where they go down and then they go out sideways, almost like spokes of a wheel, and that's what's happened in the Barnett. When you saw that proliferation of wells, most of those have been horizontal wells since about 2000, 2002. So when shale gas, horizontal drilling burst on the scene, Wall Street was only too happy to invest billions in this sexy new story. Consequently, investment in conventional gas projects has been decimated. Shale gas has grown as a percentage of all natural gas, but at the expense of conventional gas projects. So it stands to reason that shale gas accounts for a larger percentage of gas overall. But it's not in addition to conventional gas. It's in place of conventional gas. That's a very different thing altogether. So is this a boom? It has certainly been characterized as a boom. But it makes sense to look at some of the underlying reasons for this precipitous rise in shale gas production. It is a fact that while gas prices were plummeting after the economic downturn in 2008, going into 2009, many shale companies continued to drill rather than shut in wells. which has always been the traditional approach to low prices in the oil and gas industry. They would shut the wells in and wait for prices to go up. That did not happen this time. And one of the reasons it didn't happen is that shale wells were depleting so quickly that new wells had to be drilled continuously in order to maintain cash flow for these companies. Given the heavy debt loads of some shale gas operators, and they were very heavy indeed, drilling was a way to meet debt service. Financial analysts and journalists began referring to this in 2009 as the drilling treadmill. An excellent example of this can be seen by examining the audited accounts of the city of Fort Worth in the Barnett Shale. In 2008, the city received approximately $50 million in revenues. It dropped precipitously in 2009 to $19 million and then popped up again to $38 million roughly in 2010. Now that looks like you're trending in the right direction until you consider the number of wells that were drilled between 2008 and 2010. The number of wells more than quadrupled just in the city of Fort Worth. So 4 times more wells cannot keep production at the same levels that they were with 4 times less wells in 2008. That is a classic example of the decline curve realities that were exposed by the New York Times article. Another good example is in March of this year, the EIA, Energy Information Administration, announced that the Haynesville shale play, which is in northern Louisiana, had passed the Barnett in production. But the first thing I thought of was, well, wait a minute, the Haynesville only has 1/10 the number of wells of the Barnett, 1,500 versus 15,000. That means the average Barnett well produces 1/10 of the average Haynesville well. Now, excuse me, the Haynesville is a newer play, so it has not yet been dragged down by the depletion rates or the decline curves, what the industry calls decline curves. It will happen. So while there's doubt that we're sitting at while there's no doubt that we are sitting at record supply capacity, which the industry loves to tell us about, we're sitting at record supply capacity. How could you possibly question shale gas? It may be for the wrong reasons. Further, if this capacity is the product of the drilling treadmill, then it can be reasonably argued that there's very little depth behind this record capacity. Record capacity, however, instills a notion that shale gas is both extremely cheap and enormously abundant, which in fact may be a false sense of security. The Energy Information Administration likes to bandy about, and as does industry, this statistic, that the U.S. has a 100-year supply of natural gas, thanks in large part to the shale plays. This statistic, however, does not take into account the cost of extracting that gas. It focuses purely on the amount of gas trapped in shales, much of which may never be commercially extractable, as we discussed earlier. The EIA identifies significant confusion associated with shale gas estimates. In one presentation, they actually point out that shale gas, and I'm quoting here, shale gas resource potential and related costs remain highly uncertain. Indeed, some within the agency believe that the agency's conclusions may be more optimistic than is justified, given the uncertainties. Nonetheless, estimates such as those created by the EIA have been widely touted and have helped to contribute to this public perception that shale gas is both enormously cheap and extremely abundant. Now, I hope that you have a reasonable grasp of some of the questions regarding reserves and production. I know I'm having to sort of fly through this, but I only have 20 minutes. So let's move on to the financial anomalies that I spotted back in 2009 with regard to the costs in SEC reporting and even shareholder destruction. Whoa, I'm going the wrong way. According to the production history filed by operators in various states, shale gas volumes have not turned out to be as homogeneous as once thought. In the earlier days of the place, it was widely touted that you could drop a bid in and hit gas anywhere. Aubrey McClendon admitted, however, to Bloomberg in October 2009 that there was a time when you were all told that any of the 17 counties in the Barnett Shale play would be just as good as any other. We found out that there are about 2 to 2.5 counties where you really want to be. Going the wrong way. Yet even within those core areas that he's speaking of, production can be very erratic. Geologists in Houston have examined now 9,100 of the 15,000 wells in the Barnett Shale, and this is not their numbers. They have examined numbers that are filed by the operators with the Texas Railroad Commission, and they found that less than 6% of all wells meet minimum economic thresholds. It is sometimes said that further, This is a quote from Dr. John Lee. He's a professor at A&M, petroleum engineer, and he was the architect of the SEC rule change, which I'm going to get to next. Dr. Lee, in an email that he wrote to me back in March of this year, said, "It is sometimes said that 20% of shale wells carry a project. The other 80% can easily be uneconomic."